Hello everyone, welcome to Money Mastery with Sadhiq. If Nvidia were a country, it would now rank among the world's largest economies. That's how extreme this whole AI frenzy has become. But when gold is tearing through the sky, even as global equities sit at record highs, it is not just about the markets anymore. It is a sign of a possible new world order that is in play. Today, in this video, we're going to peel back at the layers, looking at the whole circular AI spending that's making the news and global capital flows to India's role in this whole economic cycle and what gold surge is quietly telling us about this shift in global power and investor confidence. Let's start with what's fueling this mania. We're seeing this whole circular financing in AI in full swing where companies are funding their own demand, right? Now, Nvidia, for example, is committed up to $100 billion in phased investments into OpenAI, while OpenAI runs massive AI models on Nvidia's own chips. Meanwhile, AMD has offered up to a 10% stake to OpenAI through warrants linked to future GPU purchases, a partnership worth billions in potential hardware orders for AMD. Oracle has pledged over $300 billion in cloud compute capacity to OpenAI's ecosystem, all of which runs on Nvidia or AMD hardware, which has catapulted Larry Ellison to the richest man in the world today. It all seems like a loop, a beautiful illusion of growth funded by itself, right? As long as liquidity flows, it all works, but when it doesn't, the whole mirror or the mirage breaks, right? I'm not trying to compare this with the dot-com bubble. I understand and agree that there is demand and broad use cases for AI and its applications. So I'm totally on board with the demand aspect of it. But my whole question is, at what cost? Now, the euphoria isn't limited to Silicon Valley or the whole US tech landscape. Probably it's due to overvaluation in US markets why investors are now pouring money into China, Taiwan and South Korea, etc., where AI and chip valuations look cheaper and the manufacturing base is relatively stronger, right? But then the whole global context is far from stable. US political gridlock, the fight between the left and right with most government services being shut down right now, rising geopolitical tensions. We saw Donald Trump announcing 100% tariff on Chinese imports as a result of news that China was planning to place export restrictions on many products, especially the rare earth metals, right? And also there is this whole de-dollarization play with American debt continuously hitting record highs and supply chain nationalism are all sort of rewriting the whole playbook or the economic landscape, right? And that's neatly where gold enters the story. Despite equities at all-time highs, gold has shattered records, right? Crossing $4,000 per ounce, the highest ever for gold till now, and just keeps getting more legs to go higher on the back of all these tensions, right? Both like geopolitically and within America with the whole government shutdown and all. Normally, according to the economic or financial theory or playbook, gold should have been cooling off over the last couple of years when equities was sort of on a risk-on rally. But this time around, gold has been rising along with equities, in fact, even faster than equities, which is a sign that investors don't fully trust the whole equity rally, right? But why? That is the question, right? Now, the answer is simple, right? It's just because this whole rally has been fragile, right? The foundation feels fragile. Around 70% of the S&P 500's gains since 2023 have come from just 7 stocks, right? The Magnificent 7. That kind of concentration is not strength, right? It is fragility in another form or disguise. And here's the deeper layer, right? This whole theme of de-dollarization is at play, where central banks are diversifying reserves away from US treasuries, buying gold instead. And as of 2025, roughly 27% of global central bank reserves are now held in gold, which is up from less than 15% a decade ago. That's huge, right? It means governments themselves are preparing for a world that is less anchored around the US dollar, and gold is and always been their insurance policy. Not cryptos. Sorry, crypto bros. India or Indian markets hasn't been spared either, right? So in 2025 alone, foreign institutional investors, FII, have pulled out close to 2 lakh crore from Indian equities so far. Why? Because India doesn't yet have like this pure play AI or semiconductor leaders. Our tech space is dominated by services, the whole IT outsourcing, generic pharma companies, specialty chemicals, etc., and not the AI infrastructure where all the money is being poured into or have been pouring into till now, right? And add on top of it the whole weak earnings growth that they've seen over the last many quarters to already stretched valuations, with Indian markets touching record highs, having grown the last 3 or 4 years since COVID, right? Add to it the weak earnings growth to already stretched valuations, and FIIs have been looking elsewhere, right? Now, the only reason why Indian markets have stayed afloat or flat over the last 1 year or so is due to the record inflows from domestic institutional investors, right? Mainly through the mutual funds, where Indian retail investors have ironically become like the shock observers of the global risk aversion, with with FIIs taking money out of the table, right? But history does remind us that bubbles don't last forever. If the AI frenzy cools off, the mega caps, the Magnificent Seven, and a couple of others may survive, but dozens of the smaller AI startups could vanish overnight, and valuations might start reacting to gravity. And that is when global capital sort of starts looking for safety again, and India's equity markets could be the comeback story, right? We're already seeing early signs of that rotation, right? So just last Friday, US equities took a sharp hit after Trump's tariff announcement on China. This could also be a blessing in disguise for India, because India has already gained due to this whole China plus one factor, and this might just add on to it. And this could also be a trigger for FIIs to start reallocating back to Indian equities, right? And if that happens, I expect the first beneficiaries to be the defensive in sectors or stocks like the FMCG stocks, Pharma, maybe even some banks, especially with RBI now relaxing lending restrictions to spur credit growth, etc. Right? Now, in fact, we've already seen 2 straight days of FII inflows over the last couple of days, which could gather pace if volatility in US and global markets continues. Sure, there might be knee-jerk selling off here in Indian markets as well, but this time the whole support base for the markets looks a little bit more stronger and foundational, which is a positive sign. With the US Fed rate cuts on the horizon, where markets are expecting more rate cuts, and probably a stabilizing rupee, where a lot of analysts are predicting that rupee's depreciation has hit the top and it might start appreciating from here on, and the domestic policies aimed at boosting consumption and credit with the GST cuts, etc. The stage looks set for global money to start rotating back into Indian equities. So hopefully this whole spurring of consumer spending and credit growth should work off, and the Indian economy and markets should go up from here. And let's always remember, markets move in cycles, which is what history is teaching us. Today's exits can become tomorrow's entries. Let us not forget the long game. AI isn't going away. It is already reshaping a lot of sectors such as healthcare, finance, education, manufacturing, the whole climate modeling, everything, right? And also the governments worldwide, including India, are treating AI as a sovereign capability, not just a corporate innovation for economic growth, right? But here's what should make us pause, take a step back and think about it, right? Nvidia's market cap before Friday's sell-off was over $4.5 trillion. If we compare Nvidia's market cap with the top countries in the world and their GDPs, Nvidia will be sitting at number 3 behind US and China, right? That's like pricing in years of growth that haven't happened yet, and assumes that margins will stay sky high even as innovation and competition is rising every day, right? The coming of GPU wars between Nvidia, AMD, Intel, and the new Asian entrants could squeeze profitability for Nvidia. AI will endure, but today's winners may look very different 5 years from now. Right? So let's watch out for that. This is Sadhiq, helping you see money the way it moves around the world. Subscribe and stay tuned. There's more insights, strategy, and perspectives coming soon. Thank you.